United States FX stocks updates. Currency, stock market, interest rate, unemployment rate, inflation rate, non-farm payrolls. The dollar index slipped below 99 on Wednesday, falling for the second straight session after Federal Reserve Chair Jerome Powell's remarks highlighting a weakening labor market reinforced expectations for further interest rate cuts. The ongoing federal government shutdown, which has prevented the release of crucial economic data, also clouded the economic outlook, pressuring the currency further. Currently, markets are nearly fully priced in for another quarter-point rate cut this month, with an additional reduction seen in December, followed by 3 more next year. The dollar also came under pressure from escalating U.S.-China trade tensions after President Donald Trump threatened China with a cooking oil embargo in retaliation for Beijing's soybean boycott. Meanwhile, the euro advanced after France proposed suspending major pension reforms, while the yen strengthened as traders unwound the Takeichi trade. U.S. stock futures rose on Wednesday, with contracts on the S&P 500 up 0.8%. The Nasdaq 100 gaining 1.1%, and the Dow Jones advancing about 250 points. The uptick followed a volatile session on Tuesday, as investors focused on a new wave of corporate updates. Bank of America climbed 3.6% in pre-market trading after reporting higher quarterly profits, while Morgan Stanley soared more than 4% after beating on earnings and revenues. Abbott Laboratories, on the other hand, lost 3.2% after a revenue miss. Meanwhile, comments from Federal Reserve Chair Powell on Tuesday reinforced expectations of an October rate cut and suggested a potential pause in the Fed's balance sheet runoff. In addition, the federal government shutdown continues, delaying several key economic releases, while U.S.-China trade tensions remain in focus, with President Trump last threatening to impose a cooking oil embargo on Beijing. The U.S. unemployment rate rose to 4.3% in August of 2025 from 4.2% in the previous month, aligning with market expectations to reflect the highest proportion of joblessness since October of 2021. The number of unemployed increased by 148,000 to 7.384 million in the period. In time, the labor force increased by 436 to 170.778 million, driving the labor force participation rate to increase by 0.1 percentage point from the over 2-year low in the previous month to 62.3%. The broader U6 unemployment rate, which includes discouraged workers and those working part-time for economic reasons, rose to 8.1% from 7.9% in July. Speaking at the NABE meeting in Philadelphia, Fed Chair Jerome Powell acknowledged that economic activity is slightly stronger than expected but warned of rising risks to employment. While the unemployment rate remained low through August, payroll gains have slowed sharply, likely in part due to a decline in labor force growth due to lower immigration and labor force participation. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen. The chair also indicated that the Federal Reserve could conclude its balance sheet runoff in the coming months, noting that liquidity conditions are gradually tightening. He cautioned that delaying action risks amplifying the impact of tariffs and potential job losses, while the recent lack of key data has added uncertainty to the policy outlook. The U.S. economy added 911,000 fewer jobs in the 12 months through March 2025 than initially reported, the largest downward revision since at least 2000, according to the BLS's preliminary benchmark revision. This represents a minus 0.6% adjustment, compared with an absolute average change of 0.2% in total non-farm employment over the past decade. Nearly all sectors added fewer jobs than initially estimated, with the steepest downward revisions in leisure and hospitality, minus 176,000, professional and business services, minus 158,000, retail trade, minus 126.2,000, and wholesale trade, minus 110.3,000. In contrast, payrolls were revised higher in transportation and warehousing, plus 6.6,000, and utilities, plus 3.7,000. The revision captures the gap between two independently compiled employment measures, each subject to distinct sources of error. A year earlier, the preliminary data showed a downward revision of 818,000 jobs, later adjusted to minus 598,000. The latest figures suggest the labor market has weakened more than previously thought.